You are listening to Mining Stock Education.
But if there's a gold company, I would say that it's still Lundin Gold. I mean, they have high margin. They generate positive free cash flow. They've got no long-term debt. They killed that off, I think, in the first half of this year. And then they make it from high grade, 10 grams, above 80% recoveries, and they produce about 500,000 ounces per year, which is significant. And then also their all-in sustaining cost is below $900 an ounce.
Welcome back to MSE. I'm your host, Bill Power, speaking today with Joe Mazumdar from ExplorationInsights.com. Joe, welcome back onto the show. Let's jump right into it and start with your thoughts about the recent Trump election. How is this going to affect commodities, metal prices, and consequently the miners?
Yeah, I mean, I guess we don't really know until he comes into office, but just on the high level as to what is being suggested, I would say his favorite word apparently is tariffs. And so I was looking at that from the perspective of the biggest consumer of commodities, which would be China. They announced that 1.4 trillion debt swap, basically, which it was, after the election to shore up their own economy because they might get hit by tariffs even harder, which might impact, their exports, which might have a knock-on impact on terms of the demand of commodities. So that's one thing. And also closer to North America, nearshoring, Mexico, they may be negatively impacted significantly because after China, his next focus was Mexico. Because his concern, and this is interesting because I was down in Tijuana on my way to Hermosillo for a conference and a site visit about a month ago now, 3 weeks ago. And I saw these Chinese airlines down there, Hanan and stuff like that. And I thought, wow, that's kind of interesting. And so I think his concern is that the Chinese might build their manufacturing centers in Mexico and then import it through what used to be NAFTA into the U.S. So he's going to try and stop that by imposing more tariffs on Mexico. And if he imposes those tariffs, and so Mexico's idea for growing their economy and blah, 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 and nearshoring is impacted. Maybe that helps mining in the end because then they say, well, we'll still have to have mining. That's maybe a green shoot for mining. I don't know. But that's a risk for Mexico with respect to the tariffs. With respect to critical minerals, I went to a conference in Toronto, a Red Cloud event. And in that, there was this woman from SAFE, S-A-F-E, which talks about critical minerals and stuff like that, and lobbies for them, I believe, in the U.S. And she was saying that the difference between the Democrats and the Republicans is that the Democrats focus on the minerals that are for transition, energy transition, whereas the Republicans are more focused on the security minerals. And so what does that look like? That could be like, okay, if lithium and nickel, and these are the minerals that are being used for EV batteries, maybe I'm less supportive of that and more supportive of those metals that China is banning the export of that go straight into the defense sector, like antimony. So that could be potentially the difference in between what they consider to be a critical mineral, their definition, versus the definition of the Democrats. And my impression is with the deregulation, that's obviously, had knock-on impacts for probably a lot of Elon Musk's companies right now. But I would say it would help in the mining sector because it's really aimed at oil and gas to help with permitting there and drilling there. But it's going to have its knock-on impacts for the mineral resources. And my best proxy for a Trump win was watching the shares of Trilogy Metals. It boomed after Trump was announced the winner. And so that was hanging. There was a gauntlet on that one with the access road that Ada was trying to put in. The permit was given under the Trump administration, then revoked under the Biden, and now And now the idea is now the Trump administration's back in, that they'll put it back in. And so they've done well. The other one would be, I would say, on a higher level would be the tax cuts. If they're put in, that might bring higher deficits, which in the long term would be good for gold and a little bit for silver. And then also, I think he wants to have a weak US dollar. But the problem is that he's going to be fighting the idea that his tariff policies are inflationary, and people are thinking that the interest rates are going to get higher. And so the US dollar is actually moving up, not down. But if the US dollar is weak, then that's obviously better for commodities and precious metals. So those are the high level things that I just based on what's been said so far that I spoke to subscribers about last weekend.
And generally, would you say that it's bullish for U.S. mining, or would you still assess that by the jurisdiction within the states?
Yeah, states still have a lot of control. If the state doesn't want it, I don't think the federal government's going to push it. But if the state wants it and the federal government was holding it back, I think that might be removed. And it was very much a federal issue at Trilogy. I don't know if this will help somebody like the Pebble project. I don't know if that'll help, because there's a lot different constituents of who's against that project.
And wasn't that denied during the first Trump term as well?
Yes, it was. Yeah, and that's what people got to watch. Trilogy was definitely, and then maybe that land swap with Resolution and Rio Tinto, with I believe it's the Apaches in Arizona, that might go through. So those sort of things are the ones that would have the biggest benefit.
What about the boundary waters in northern Minnesota too, with projects up there?
Yeah, I doubt it. That's a very state thing. I doubt if that would change, because I don't think the federal government's going to go around and imposing their will on the states, especially Republican states. So I think that it'd still be a state thing, but if the state's for it and the federal government is the issue, then that issue might be gone under the Trump. But also permitting, drilling on BLM land, and this is important, and hopefully on U.S. Forestry Service land will hopefully be faster, and getting through plan of operations and that, hopefully that'll move faster.
But that goes by the local bureau's office too, right?
Yeah, it's a local bureau of a federal, commission or whatever you want to call it. But I think that they will try to push these things faster. So if the state governor or senator goes to the federal regulators and says, hey, this guy's really slow with this, what's going on, they might speed the thing up, especially if the state wants it.
Joe, when you look at the junior mining sector, where and when do you see the biggest opportunities for arbitrage or market inefficiencies?
Well, I would say, like, I've been seeing a lot of this is where it's really about access to capital markets. You can get a management team that's okay, and they might have a decent asset, but they have no access to capital. And so they're always sitting low because people are wondering how they're going to raise money. And so when you bring in a new management team that has access to capital and the asset's still pretty good, that could generate by itself a big premium, because now the shareholders are potentially less worried about where they're going to raise money, but also there might be an inflow of other people that have made money off of these people that want to go for another ride. And so for me, that's a good indication. Those are obviously hard to predict, but when you see that, that's something you should look at, because as we know, markets are very volatile, and especially for non-cash flowing companies. And when you have a team that has more access to capital, that basically that's lower cost of capital. That's a big inefficiency that gets resolved quickly.
So kind of another way of talking about what you just described is that a project or a deposit is only as valuable as the people who control it, would be another way?
Yes, absolutely. And so when you do see that management change and you go, wow, okay, that asset was good like I thought, but it wasn't the asset, it was the people, which you probably thought as well. But there's no way that you could predict that this was going to happen. But when it does happen and you already did your due diligence on the asset, now you have the team that can not only advance the project, but they can fund the advancement.
Mm-hmm. Barrick missed their production targets. Any commentary here you can provide?
Yeah, I mean, the thing is that their gold price, what I looked at from a high level, I mean, the gold price was actually up Q3 24 to Q3 2023, so year-on-year quarter changes. So 30% increase in realized gold price, but then their all-in sustaining costs went up about 20%. And their production dropped by about 9%. So this is not the kind of leverage that somebody who sees a higher gold price would want. They did generate more revenue. Their EBITDA went up and their free cash flow. But in terms of, looking at, direct leverage to gold, if you produce less at a higher cost, then that's, that sort of curtails some of the leverage. And then also they're guiding to the lower end of production going forward. And then probably, I don't know how much is involved in this, but long term, a lot of their growth is coming from geopolitically risky places like Pakistan with Reko Diq and the expansion of Lumwana, and a lot of that's copper and not gold. So I think that they had that big push for copper. So don't be surprised when you're pushing for copper that you have less leverage to gold.
And you think the market's efficient in discerning that within Barrick in terms of how they value it?
Yeah, well, I've seen this before in the 2000s when I was with Newmont, that when companies were pushing for more diversification, that diversification cost them in terms of leverage.
Mm. And do you think Barrick's missing their production guidance, has that hurt the whole sector as a whole?
Yes, I mean, just as Newmont did. Like Newmont had some good numbers in terms of financials, but people were still worried in terms of production. And the problem is that when you see that kind of level of production, it's next to impossible to keep it up. And so they're only looking right now, their catalysts are the divestments. Like they just sold, I think it was Achim in West Africa to Zijin, and Zijin's buying up. And they paid $1 billion for that. And they were also, Zijin was involved in one of the streams on that Montage Gold project. So as some of the Western companies are divesting, the companies from the East, mainly China, are buying. So what does that say? We've seen this before.
Mm-hmm. If you could buy one gold producer, what would it be?
Like when I did my Q2, I think half year sort of resolution about, gold companies, I came back to my conclusions from the year before in terms of companies. So if you want leverage and you believe in a higher gold price, there's companies to own, but leverage cuts both ways. But if there's a gold company, I would say that it's still Lundin Gold. I mean, they have high margin. They generate positive free cash flow. They've got no long-term debt. They killed that off, I think, in the first half of this year. And then they make it from high grade, 10 grams, above 80% recoveries, and they produce about 500,000 ounces per year, which is significant. And then also their all-in sustaining cost is below $900 an ounce. There's not a lot of companies. So you've got a lot of gold could go down, but these guys will still make money. So for me, the biggest risk obviously is in Ecuador, and that's what you're paying for. But yeah, in terms of a single asset producer, it's hard to go wrong with that one right now.
And then you trust the Lundins for capital allocation in order to acquire future reserves, I would take it?
Yeah, the problem is with some of these assets that are so good, whatever you acquire becomes dilutive in terms of quality. And I've seen companies that have had to deal with that. So you have to really watch what you acquire. But what you could do is if there's a really good asset out there, and I'm sure they bid on this, to look for what are my comparative advantages? Hey, I do underground mining in these kind of terrains. Hey, I can also handle complicated metallurgy, because some of the stuff's semi-refractory. But also I can work under these conditions in an emerging market. So are there assets like that out there that that are caught in sort of like the orphan period in the Lassonde curve that I could buy, and then all of that would accrue to me because I got access to capital. Technically, I know what I'm doing. I mean, similar to what G Mining's doing. G Mining is, not quite got into commercial production at Tocantinzinho and bought Reunion Gold. So, because their advantage, their comparative advantage is they're builders. And so they can bring this building, but it doesn't accrue to the company they're acquiring, it accrues to them in the end. I would have hoped they would have done that after they got into at least commercial production at Tocantinzinho. I was surprised that they did it so quickly. But as we know, that the problem with some of these guys is that remote projects can be problematic. And we've seen that with the results from B2 Gold. How they've raised, I believe, the capital on the Goose project by another 20 to 25%, because one of the reasons was they missed the window in terms of weather to get more supplies in. But that'll be a constant issue going forward in terms of weather windows and how much working capital you need to keep that thing operating. So, remote projects, as Teck has proved with QB2, and B2 Gold continues to prove with Goose, are not easy. And nobody wants to overpay for a remote project because they know the capital number's wrong.
So, Joe, if you have a tier one gold asset like Kirkland Lake had, or like Lundin Gold has in Ecuador, and if you acquire a lower grade or lower tier asset, it would dilute the value. Does it make sense to perhaps sell the company at a peak? Kirkland was sold. I mean, could you see the Lundins doing that, or they like to acquire and build and grow themselves?
Yeah, I think that they probably think of Lundin Gold like Lundin Mining, like, here's a seed, let's grow this. They probably think like that, and we can be strategic about this because we're making money at all parts of the cycle. So when the cycle goes down the other way, we'll be the acquirers. But we can be patient. Let's keep looking where we're close to. Let's find more free feed for our own plant. Because that's probably the highest value thing we can do, is increase the value of our high value asset, as opposed to going out and buying another thing that might be overvalued. Because not only do they have free cash flow, but they also have the value of their paper. Because usually in these markets, the high margin guys don't do as well as the low margin guys, because the low margin guys have the more spectacular growth in margin when the gold price goes up. But Lundin's done well. But I think their complication is right now their asset is such a high quality. Where do I find another one like this? And they might have thought about the Cerro, the one in Guatemala, the Bluestone one, which was also sort of run by the Lundin Group, but that just became too complicated with the government and getting permitting and stuff like that. That was sold for next to nothing. So yeah, they'd be concerned about jurisdiction, and they'd be concerned about how remote is remote, and because they'd have a pretty good idea what the real capital number is. So they don't want to overpay for these things.
And are they not concerned about single jurisdiction, single asset risk, you think?
Oh, absolutely. I'm sure they are in terms of Ecuador, and now it's sort of like the crime rate and things like that. But in terms of where they are, it's harder to rob them on the road or anything like that, I think, than what we see sometimes happening in Mexico right now. I think Newmont at Peñol, they had a problem at one of their projects that they had, I think it was a concentrate truck or something like that, where material was stolen. Probably harder to do there, given the remoteness of the project.
So we're headed into what is historically the season for tax loss selling, or some call it tax loss silly selling season. With gold hitting all-time highs here recently, do you expect that to be lessened, the impact of tax loss selling this year?
Yeah, I mean, one thing is the gold price, but what we're selling is not gold. We're selling the equities. And as we look, I mean, the GDXJ to date last weekend was up 30%. A base metal equity ETF XBM was up 17%. Uranium equity ETF was up 12%. The only one might be the people that were too much into lithium. because those equities went down, they might be considered tax loss selling. So I would suspect that it would be less of an impact this year than last.
When you're looking to put companies on your watch list, what are some of the qualities of the companies that are good enough to make it onto your watch list? But then what do those companies typically lack to where you haven't issued a buy yet on that company?
I guess my single most important mantra is I don't want to put anything into the portfolio because everybody's seeing my portfolio that's a subscriber. I don't want to embarrass myself. And so management's very important. And so if I have this company and I put this management team in front of people, I have a good idea that they're not going to embarrass me. So management's key, especially with the non-cash flowing exploration companies, because better management teams lower cost of capital is because they have more access to capital. So, and the management team, especially for exploration and development companies, technical acumen is important. And the technical acumen has to be specific to the terrain that they're in geologically, the deposit that they're looking for, and the jurisdiction. And then also, what are they thinking about in terms of exploration target? Do I think that's conceptually possible in that terrain? And is it big enough for somebody else to want? And can I make an argument to myself that this would be something somebody wants? Because still at that juncture, I'm not looking for this company to build it, but I am looking for strategic players to come in and help fund it. So those are some things that I look at. Commodity as well. So which commodities do I want? But that's probably secondary compared to all this. And then for development, same sort of thing with respect to management, history of success in terms of developing projects, hopefully on time and on budget. And the technical acumen is more diverse because now we have to not only explore, but let's explore now develop. So we need engineering with respect to developing, understanding operations, how they work. Again, access to capital, fundamental because they're still non-cash flowing. And to understand, when to take debt and when not to take debt. To do a stream on your main product, that's a bad signal to me. And then, look at the value of the asset, grade, tonnage, metallurgy.
Was it G Mining that did that though? Did they do a stream on their main commodity, or what was the company that did that?
Montage did.
Montage. Sorry. Okay.
But
Yeah.
I think given the security risks of West Africa, it's going to be hard to get there nowadays. Because we just saw, Montage is in Cote d'Ivoire, not Mali. But Mali, they just arrested a bunch of people from Barrick and now executives from Resolute Mining recently. And so that's going to be hard, because these people want to negotiate, but they're not going to go there in person anymore to negotiate. And then now they're worried about, how their operations can continue, because if they don't negotiate and give them the terms, then suddenly does everybody get arrested? So that's not the way people want to work.
So avoid Mali for now as an investor.
Yeah, I'm not right now. There's nothing in the portfolio from West Africa. West Africa is still an easy place to build. They have less problems building. Permitting is a lot easier, but some of these places have security risks. 10 years ago, Burkina Faso was, a shining light. Now it's gone to a dim star. So now Cote d'Ivoire is a better place, but you wonder how long is that going to last? And so for some people, I would say West Africa is not on everybody's high ranking list, and so the cost of capital to do anything will be high, and so I can understand the reason to stream, but I would point out that Montage Gold, because they raised a lot of money as well, they used some of that money to buy puts. So they bought puts on their gold production to not only ensure cash flow, but to use that cash flow to buy down some of these streams. So I think that was a brilliant move on their behalf.
And the Lundins are involved in Montage too, right?
Yeah, no, it's got a great registry. And so if you're going to be involved in some place like this that's high risk and stuff like that, you'd want those kind of people involved. But let's remember, this is still like a 1 gram mill deposit. It's not like a 2 gram open pit or anything like that we're talking about. It's got slightly higher grade during the payback period, but their idea is that this is the plan, and hopefully they can get some more stuff and fill it with higher grade. But yeah, this is a 1 gram milling project in West Africa. And West Africa has not only had the problem with security issues, but with these, low grade open pits that need, bigger plants, they need more power. And power has been an issue. And not the cost so much has been the availability of power, which hurt a lot of companies in the first half of this year.
Joe, when you're looking at a development company that needs to utilize a smelter to fully extract the minerals, do you think that the economics that they put forth could be a little deceptive at times, especially when they're talking, let's say, an equivalent, copper equivalent or what have you, because they may not be fully pricing in what it's actually going to cost to smelt those metals?
Yeah. Okay. So in the exploration stage, we see a lot of this equivalent stuff, like silver equivalent, copper equivalent, whatever they need to be equivalent. I haven't seen an antimony equivalent yet, but that might be coming. So the problem with the way I look at it is that what are you actually going to produce? And so, is it actually going to be gold bars, silver bars, if we take the precious metals? If it's not, and let's say 70% of the gold is contained within concentrates that go to a smelter, then for me, that's a completely different thing. And then your product isn't the gold anymore. It's this copper concentrate or this lead concentrate or this zinc concentrate. And each smelter will give you different payables for gold because that's not what they want. They want the zinc, they want the lead, and they want maybe even the sulfur, because you could do a sulfide con, which some people call a pyrite con, and you could have the gold in there. Then the problem becomes that's the product, and the buyer is the smelter, and the smelter is looking at it from a completely different perspective. They're looking for how much lead does this have, how much zinc does it have, how much copper does this have, and then when they look at that, they go, well, how much antimony does it have, in terms of being a deleterious element? How much arsenic does it have? How much mercury does it have? Because this is all bad for me. So if I take that, I'm going to be charging you for that. And so there's this thing called TCRCs, which are basically the charges, the treatment charges and the refining charges to the smelter charges. And so the more they charge you, the worse your product is. And the problem is that if you have a product that's not very good or high quality, there'll be few people that want to buy it. And so not only will you be charged a lot, but you might have to go to this one smelter in the middle of whoop whoop, and the freight costs might be ridiculous. And then they might really not care about the payables. They might say, oh, it's only 50% for gold or 60% for gold, and take it or leave it. I don't care because I don't really want your material anyway. So that is the issue, because it's not like selling a gold bar. A gold bar is a fungible thing. That's probably 99.99 whatever percent gold, and you can get to a refinery where you upgrade it. But otherwise, if once you get into selling a concentrate, that's a completely different product. And to understand that product is important to understand the value of the project.
Joe, last time we talked, you talked about the use of AI in mining and in assessing potential deposits. Any updated thoughts you could share here?
Yeah, I don't know how deep I went into that, but I mean, I'm working with a guy out of Denver called Tacit Vision. His name's Aaron McMahon, and he's got this.
And
tool.
We had him on the show after you mentioned him, by the way.
Yeah, and so I think that is a good way for people to try and understand what a resource could be. And as we know, a resource is why we drill. But we drill with, the diameter of a bottle of Malbec, basically. And then we're trying to say, okay, 25 meters on everything on either side is equivalent to this drill hole. And that might be all we know. And so now we're trying to understand what it is, but we're trying to understand it deterministically, like saying, here's a point value. And it can't be a point value because there's so much risk in what we're trying to say here. And the risk gets diminished somewhat the more holes we drilled and depending on the deposit. So watching the variability of the deposit, will determine how much drilling needs to be done and how much variability there could be in the resource. And so that becomes your biggest risk. And so with these kind of tools, you can get an idea of your downside and upside to know that, am I paying too much for this? Is there limited upside to this? Or is it all upside going forward? Like we did that example where we showed Rubicon, and then when they came out with their initial resource, and I believe they had 20 grams, and in his model, that number wasn't even in the distribution. So you knew coming in that, oh, do I buy after this resource? The market seems to love it. It goes, whoa, that looks like beyond the upside. It can only go down from here. So you technically would have started selling then. And so these kind of things help you in trying to decide whether you should buy, hold, or sell. And so that's one reason I'm using the tool in Exploration Insights.
Joe, you mentioned you were in Mexico recently. Any updated thoughts on Mexico as a jurisdiction?
Yeah, I think we're still kind of screwed there in terms of exploration, definitely. Development of open pits, I don't know, because people say, oh, she didn't talk about it in her whatever 100 points or whatever, but I don't think she cares about it. Their big risk right now is nearshoring, and that's where 100% of the new president's focus is, because that's where they think the growth can be in the economy. That's what's going to grow the GDP, and that's going to make the Mexico peso stronger. So that's what she's all about. But with the Trump presidency, and like what we said, with the potential advent of tariffs, that can be more problematic. And so she's probably going to fight for that as much as she can going forward. And that'll probably be 100% of her focus through the first few days, 100 days of the Trump presidency would be on this.
Any site tours you've been on recently that you could share about?
Yeah, well, I was down in Wyoming, and I was pleasantly surprised that Wyoming is a state that's actually using it, because they're an oil and gas state. And I didn't know Sinclair, the gas station, actually came from there. There's a town called Sinclair.
With the green dinosaur.
With the dinosaur, yeah. And also, for those geologists out there, the Brunton compass is actually made in a town in Wyoming. I didn't know that either. But anyway, so Wyoming is actually using, because they think that the oil and gas market might be coming down eventually, just like the Saudis do. And so they're looking also to diversify at a different scale, but they're actually paying for geophysical surveys and that over their entire state to get people to explore in their state. And they're also doing this thing where if you come up with a budget, multi-year budget, there's a potential that they'll fund some of that themselves. So they're trying not only to level the playing field between big companies and small companies in terms of giving information, just sort of like what they do in the Australia Geoscience, but they're also trying to lower your cost of capital. And I think it's a much better way of doing it rather than flow through, because flow through you can spend on G&A, you can spend on a lot of things, but that money, is definitely on the ground because they spent it and then you're backing them. I think that's a good way for other states to consider doing things going forward. And
that info becomes public knowledge, I would guess.
Exactly.
Yeah.
It just goes up because it's in their best interest to accelerate the program, because if a big company does it, they keep it. They don't give it to anybody. And so the other thing that they're trying to do is when people actually do exploration, it'll have a moratorium, but after that, it becomes public data. It's the same thing that we used to do when I worked in Queensland in Australia. You wrote annual reports, then after you gave up the property, you had maybe a year or two, and then all that information became public.
Isn't it like that in Quebec too, though, to where it has to become public?
Yeah, I don't know about Quebec. I never worked there, but yeah, if it is, that's great. But I think the involvement of the government to actually help people by providing more good information about the state, not only geology maps, which have to be improved, but geophysical surveys, all this sort of stuff, helps a lot, and when they do, like the Quebec government and some of these other places like Finland, they do geochemical surveys and databases and stuff. That's all very helpful and a better use of their capital rather than just giving companies money to spend. If they spend it, match it. and then take some of their spending out by giving them these surveys, which anybody can use, and again, level the playing field between them and bigger companies.
Joe's website is explorationinsights.com. You can go there. There's a bunch of free resources, especially if you're newer. There's some educational resources there. And if you're looking for guidance at picking early stage companies and development stage companies in the junior mining sector, Joe also offers a paid-for newsletter in which he delves into the technical aspects of these companies, analyzes it from the perspective of an investor, and he often goes to the sites and checks out these projects and companies before he recommends it. Joe, would that be an accurate summary of what the newsletter offers?
Yeah, I mean, we've done a lot of site visits this year, and then this Saturday I'm heading down for a 2-week visit down back to Peru, Mendoza in Argentina, and Chile. So yeah, that should be fun before Christmas.
Excellent. Well, Joe, really appreciate your insights. I'll reach back out to you in about 3 months to come back on the show.
Great. Thanks, man.
Thank you.